Generational wealth refers to the accumulation of financial assets that are passed down from one generation to the next. This concept is a central topic in the study of economics and sociology, as it influences family financial stability and economic mobility over long periods. Historically, this transfer has taken many forms, from physical property like land and real estate to financial instruments such as stocks, bonds, and business ownership. The mechanisms for this transfer are often governed by legal frameworks, including wills, trusts, and estate planning laws, which dictate how assets are distributed after an individual's passing. The study of generational wealth often begins with an examination of asset accumulation. This process involves the acquisition of items of value that have the potential to grow or generate income over time. An individual's income, spending habits, and savings rate are fundamental components that contribute to their ability to accumulate assets. Financial education materials often describe income as the flow of money received, typically from employment, business, or investments. Expenses represent the outflow of money for goods and services. The difference between income and expenses, if positive, results in savings, which can then be allocated toward acquiring assets. This cycle of earning, saving, and asset acquisition is a foundational principle in personal finance literature. The assets that form the basis of generational wealth are varied. Real estate, for instance, has traditionally been a significant component. This includes residential homes, commercial properties, and undeveloped land. The value of real estate can fluctuate based on market conditions, location, and economic trends. Another major category is financial assets. This broad classification includes equities or stocks, which represent ownership in a publicly traded company, and bonds, which are essentially loans made to a corporation or government entity. Business ownership is also a common vehicle for wealth accumulation, where a family business is passed down, continuing its operations under new leadership. Beyond these, cash, precious metals, and collectibles can also be part of an estate. The transfer of these assets is a critical phase. Estate planning is the process of arranging for the management and disposal of a person's estate during their life and after death. It aims to ensure that assets are passed on according to the owner's wishes while navigating the relevant legal and tax regulations. A will is a legal document that outlines these wishes. In the absence of a will, a person is said to die intestate, and the distribution of their assets is determined by state laws, which may not align with the deceased's preferences. Trusts are another common tool. A trust is a legal arrangement where a third party, known as a trustee, holds and manages assets on behalf of a beneficiary or beneficiaries. There are many types of trusts, each with different rules and purposes, such as protecting assets or providing for minors. Financial literacy is often cited as a contributing factor in the management of inherited assets. Understanding concepts such as compound growth, asset allocation, and risk diversification can influence how beneficiaries handle the wealth they receive. Compound growth is the process where an asset's earnings are reinvested to generate additional earnings over time. Asset allocation involves distributing funds among different types of assets to manage overall portfolio characteristics. Diversification is a related strategy that involves spreading investments across various financial instruments or industries to reduce concentration risk. Without a foundational knowledge of these financial principles, beneficiaries may face challenges in preserving or growing the assets they inherit. Consequently, many discussions around generational wealth also emphasize the importance of passing down financial knowledge alongside monetary assets. Economic factors play a substantial role in the creation and preservation of generational wealth. Inflation, for example, is the rate at which the general level of prices for goods and services is rising, and, subsequently, purchasing power is falling. Over time, inflation can erode the real value of saved money and certain fixed-income assets. Economic cycles, including periods of expansion and recession, also affect asset values. During an economic expansion, asset prices may rise, while during a recession, they may decline. Tax policies are another external factor. Estate taxes, inheritance taxes, capital gains taxes, and income taxes can all impact the net value of assets transferred between generations. The specific tax laws vary significantly by jurisdiction and can change over time, adding a layer of complexity to long-term financial planning. The conversation around generational wealth also involves sociological dimensions. Studies have shown that the presence or absence of generational wealth can have a significant effect on an individual's life opportunities, including access to education, entrepreneurship, and housing. It can provide a financial safety net that allows individuals to take calculated risks, such as starting a business, or to weather financial emergencies without falling into debt. Economists study these effects to understand broader patterns of economic inequality and mobility within a society. The concentration of wealth and how it moves across generations are key areas of research in understanding the structure of an economy. The subject highlights the interconnectedness of individual financial behaviors, family dynamics, legal systems, and macroeconomic conditions. Therefore, a comprehensive understanding of generational wealth requires a multifaceted perspective that encompasses personal finance, law, economics, and sociology.